Welcome to another edition of Zacks Rank Buy. I am Brian Boland, and I am the aggressive growth stock strategist here at Zacks. And I got two more stocks for your aggressive growth radar screen. So let's go right to it. The first one that I have here is Rover, the Rover Group. ROVR is the ticker. It's a Zacks Rank #1 strong buy. It's got the growth divergence that I love to see. A very strong growth style score and a very weak Zacks value score. So people say sometimes, Brian, why wouldn't you want a great value and a great growth? And I say, well, normally I want to see that strong growth, and growth investors are going to be looking for different things than value investors. They're just basically on different ends of the spectrum. So when I see a weak value score and a strong growth score, I know as an aggressive investor that I'm more likely than not going to find something that's great, that what I am looking for. Sometimes it works, sometimes it doesn't. But that's the main reason there. So we can see right here from the chart that this company reported earnings, and it was a big winner. So let's go into the numbers that we always take a look at. We have our earnings history here. We didn't have, I guess we have an NA there. That should be a beat of 300%, obviously, because it was a beat of 3 cents compared to a break even. Then we got a 50% beat here where we slip back to unprofitable, not profitable, thinking you're going to be profitable here, but or not profitable there. And then you turn up. Yes, it is profitable, 400% beat. So that skews the average quite a bit. And most recently, that 2 cent beat there for a nice 66% positive earnings surprise. What has that done to the numbers? Well, I don't know that these, because this earnings report was just the other day, but we'll just go 3 to 5 cents. So yeah, it is for the next quarter. So a little bump up here for the estimates. For that first quarter of next year, we're holding flat at a negative. This year, they're holding at 3 cents, which is weird to me considering that this quarter is bumped up after a beat. And then next year, up 8 cents to 10 cents. So for the most part, we're looking at good estimate revisions. We don't have an actual sales consensus number from before, and I think that number is too early right there. So we don't. I don't know. There's a ghost in the machine for our sales numbers. So let's jump over to the valuation number. So we see a 30% top line growth in the most recent quarter. That's great to see. We have a gigantic PE, and that's a function of earning a very small amount of money, very few cents. So 10 cents, and the stock is at $80. We're looking at 80 times for next year. 80 times when we think about 2024. Price to book is relatively expensive for this sort of business. It's the thing that you need your dog walked, you need a pet sitting, you need something like that. This is the place that you go to find, and it's that kind of gig economy, if you will. So that's the focus of this segment. So importantly here, I think it's the move in margins. We went from, a loss of 2% to 2 to 7.5, just like that. Margins really kicking up. And that's why I think you get that gigantic move in the stock. And I didn't line up my chart, so we won't even look at it. But there's a big move in the chart for Rover, ROVR. All right, so next one is Pinterest, PINS. And if you will, this is something along the lines of the gig economy. It's a Zacks ranked #1 strong buy, A for growth, F for value. They too reported and beat, and the stock shot higher. Great to see for anyone who was long the company. Earnings, again, here we've got a 3% beat. That should be a gigantic beat. This is a solid beat, and then another one. So obviously the financial house is in order here. They're guiding where they should to the beatable number. All right, 46 cents to 50 cents, 13 cents holding still next quarter, 96 up to $1.05, $1.12 up to $1.26. All good positive earnings estimate revisions. And here's what gets you excited about this name. We're going to get about 9% growth on the top line this year, but accelerating to almost 17% next year. So growth here, deeper story in there is probably the advertising that they're able to generate there. But 30 times, is probably a good number if you're going to double growth. 11.5% top line most recently. Price to book 7.4 times. That's why the value guys don't like it. 7 times sales. Margins have improved dramatically. I mean, we're looking at losing 5% to just a little bit below to losing 2%. So that's great. Great to see. So Pinterest, let's take a look at their chart. We got that one? I do. Boy, I hope that's Pinterest. Pins. Okay. Let's take the idea here that we always do. The world's going to end the pandemic, and then it's like, oh, we're all going to be at home. We're all going to be on the internet. And, tech is getting pummeled. Tech's pummeled. But we've been holding still down here for quite a while. And the chart people might say that that's basing. There'll be a very long base. So they resisted the urge of a bear flag, which is a down move, and then move like that, and you'd expect another tranche down. But it didn't have that. So what I like to do is look at this distance between these numbers. And I think basically right about here, we all of a sudden decided, well, we're gonna run this thing a lot higher. So Pinterest is definitely, it's a bigger stock, it's a bigger name, but it is something definitely to be looking at. All right, that's it for this week. Be sure to join us next time when we put 2 more stocks on your aggressive growth radar screen. And until then, why don't you go to Zacks.com/promo to look at all of our latest promotions.